Thank you to everyone for joining us today. I'm delighted to welcome Johanna Kyrklund to join us from Schroders to speak to us today. Johanna is the lead manager of the St James's Place Managed Growth Fund and is here to talk about her fund, the global market, anything else that will come up during this Q&A. And I'm sure there'll be some questions on topical events as well. My aim here is to get through as many questions as we possibly can, as many market themes as we can, and this session is shaped around the questions we've received in advance from attendees. Please note this will be focused predominantly on investments, and the reason I mention that is we've had several questions about the upcoming budget and the implications of it, for which we'll be producing a post-budget webinar the day after the budget for clients on the 1st of November. If you have any specific questions on your own situation, though, regarding the budget, please contact your St James's Place partner about that. Now, as you may have noticed, we are live streaming in person from Schroders offices today. So in order to shape the session even further beyond the questions that have already been submitted, you'll be about to see a question pop up on your screen. We will focus the question from there. So hopefully you'll see the question on screen right now that will focus on, from these market concerns, which one stands out to you as the most significant. So what I will try to do is concentrate the areas that the audience want. So I'm filling time right now, well, in the 15-20 seconds we've got left to see what the results are. So please vote for the one that stands out the most for you as the most significant. So thank you very much for that. To start the question off, Johanna, can you introduce yourself for those who aren't aware of you or dialed into one of these before? Can you introduce yourself, your role, how you manage money for St James's Place investors?
Sure. So yeah, so I'm Johanna Kyrklund. I've got 27 years of investment experience, always focused on managing what we call multi-asset portfolios, which bring together a range of asset classes and are really focused on delivering a one-stop solution for your clients. So I think the idea is this can be a core allocation where we will make adjustments to the exposures over time to take account of valuation and the economic environment, really aiming to evolve that strategy to take advantage of market opportunities. So that's it in a nutshell. And I'm CIO here at Schroders as well, the Chief Investment Officer. Yeah.
Thank you. Look, so what we've just shown with the answers that have come in, which said that the biggest concern for investors was geopolitics and potential economic downturns. It won't be a surprise to know there'll be some questions on that. So many questions in advance were about politics in the UK, like I've already said. And while we don't necessarily want to go down the political route, I want to explore that from an investment point of view. So let's address it from an investment point of view. In terms of the change of government in the UK this year, has that actually changed anything for you with regarding your asset allocation to the UK or anything like that?
No. In a word, I mean, I think that obviously there'll be sort of implications with the budget that you will be covering with your advisors from a tax perspective, and that's not my area of expertise. But from a top-down market perspective, the performance of the UK market is really a function of its sectoral exposure. It's quite old economy, traditional companies, quite cheap, so it tends to do well when value's doing well. And it's also a function of sterling because we have a lot of overseas earners in the FTSE 100. I don't think that the labour market is a challenge, certainly for the UK stock market. I think in general in this country at the moment, there's a lot of concern about the need to ensure that we do have a thriving corporate ecosystem. I think that view is shared by both sides, both the Tories and Labour, and we haven't really seen a meaningful shift in strategy from that perspective to the extent that we interact with the government. So yes, I think it's not something I worry about.
Is there anything that would give you any additional optimism in the UK or for the UK economy generally? I mean, would we be entering a period of political, or in theory, political stability? Does that help the UK economy in any way?
So I think there's a number of things. I think the first thing is that in some senses, because we've had the gilt crisis, we've had a bit of a sort of vaccination against irresponsible fiscal policies in this country. And certainly that has been sort of continued by the Starmer government. So that's good news, not something you can necessarily take for granted in other markets. So that's good news. I think that, you know, whatever opinion we might have of our domestic political situation, I think the view from international investors was that things were a little bit erratic in recent years. A lot of international investors didn't understand Brexit. And I think the fact now that we have the potential maybe for a sort of more constructive dialogue with Europe, I think is supportive of markets. So all of those things, that political stability is important, particularly at a time when maybe other areas of the world are seeing less political stability. So in that sense, it's certainly, I think, good news for the UK.
We might be getting on to other areas of the world in
Yes.
due course. But what I want to cover off first is the UK. That's where most of the questions have been about. There is a home bias to that, completely appreciate that. And even though the UK economy makes up such a small amount of the global economy, it is an area of concern for a lot of people.
And it has been doing very well. I mean, this year, the UK is one of the better performing markets globally. There was a brief moment in the spring when it had better momentum than the NASDAQ.
Sure.
So, I think it's a good contrarian opportunity.
Yeah. I did see a stat the other day that suggested that if you look at the S&P returns...
equal weighted.
Well, with the market cap weighted, if you take NVIDIA out of that, then actually the FTSE 100 has pretty much done virtually the same.
Yeah, so I did literally that exercise on my Bloomberg the other day, and I was looking at the equal weighted S&P 500 versus the FTSE. And you're right, and that does essentially the same thing. It takes out those sort of big names, or reduces the weight of those big names, and then suddenly you start to see a much more positive picture for the UK.
Yeah, we'll get onto technology sector as well further down the line. This is more topical than anything else. Last week, the Bank of England kept rates at 5%. Has that changed anything? It felt that the market just shrugged that off, and it was expected. Bank of England keeping rates at 5%. Is the medium term still the same as it was?
I mean, ultimately, we still believe they'll be cutting rates gradually. We're sort of assuming a quarter point every quarter. So the important point is that, rates are peaking, and it's just a question of the speed at which they peak. But I think there is an opportunity for the Bank of England to ease policy a little bit. But we need to recognise that, labour market's still quite tight here. We do need to keep an eye on inflation as well.
And in terms of the day before the Bank of England kept rates at 5%, the Federal Reserve had cut rates by 0.5%, which was headline grabbing, but it was a week of, will it be 25 basis points, will it be 50? 0.5, does that change anything at all?
Well, I think what it does is send an important signal, and that was really evident in the statement that they released, is that unlike the central banks here in Europe, which are very much focused on inflation, the US Federal Reserve has a dual mandate, not only to preserve price stability, but also to preserve full employment. And at the moment, inflation's moving in the right direction. Actually, the labour market's still pretty solid in the US. The fact that they're willing to start cutting rates that aggressively, they're allowed to because inflation's come down. But what they were basically saying is, look, we have a dual mandate and we also need to preserve employment. So it's quite a pro-growth Fed that we're dealing with, and that is positive for markets.
So one of the questions we had, again, there's a lot of different questions that have come in, and I'm trying to get them down to themes rather than individual questions. So one of the questions that did come in was about US valuations, and I'm going straight to this because you've just mentioned about trying to get growth, et cetera, et cetera. And the question was simply, does Johanna think US equity valuations are reasonable? That's quite a broad question, but...
Yes. In a sense, today I'm in a one-word answer mode. Why yes? Because clearly they're lofty, there's no question. But it comes back to the sectoral composition and the high weight towards some of those technology names. And do they look quite expensive? Yes, they do. Are we back to the internet bubble type of conditions that we had in the late 90s, early 2000s? No, we're not.
Okay.
So when we look at the analysis, and I remember back then we're literally looking at stocks in terms of price to clicks, because there were no earnings in those internet stocks, right? So you sort of, their valuations are measured on how many people were clicking on the website. We're in a very different world. I mean, a number of these big tech stocks are highly cash generative, have delivered the earnings. So while they've clearly done very well, I think there's some sign of exhaustion. We've really seen that since the second quarter. It's not a bubble like it was in the late 90s. And I think the other thing that's interesting is rates start to fall. We're seeing a broadening out of equity performance in the United States. So it's important to note that the US has had a bit of a two-tier market with these tech names doing very well, but the broader market languishing quite a bit, really.
Yeah.
And there the valuations are not as extreme. So I think we can justify the valuation of the US market.
Okay. And from an asset allocation point of view, in terms of, I think people have got into a habit of splitting out the US into tech and ex-tech. In terms of your own asset allocations, in terms of tech exposure, is it as much as the market, or is it?
Yeah, we still own the S&P 500.
Yep.
So again, we sort of think that the tech story can continue and there's opportunities in the broader market.
Yeah. We went through the 2010s and it felt like rates were everything. And in particular, when you get to a point where bad economic news was almost welcomed by the market because it meant that rates would stay low, it feels like in many ways things have evolved and things have got a bit better economically. But with all the rate speculation continuing, has the market moved on beyond bad news equals good news for the market? You know, is the market still as obsessed with low rates as it was?
So structurally, in the last decade, we were dealing with a very deflationary environment. You know, the financial crisis of 2008 cast a very long shadow over the market. And we also had a policy mix that, you know, was quite anti-growth. We had very tight fiscal policy. If you remember, we had austerity here after the financial crisis. And then very loose monetary policy. And in a deflationary environment, actually, you know, that rates were very important in offsetting the consequences of that for growth. And in particular, so that it was very much about rates back then. We are in a different environment now in the sense that we're now seeing much more proactive fiscal policies around the world. Generally, I think a stronger tone to growth, higher nominal growth, certainly. And I would argue that inflation is, in some sense, been normalized compared to the last decade. So we're not in a deflationary environment anymore. In that environment, you need to deliver the earnings, though. You're absolutely right. So there's truth to what you're saying. I guess with one major caveat, we are dealing with a slowdown now. We're in a rate cutting phase. And that is typically an environment which, you know, where actually what happens to inflation and what the central banks are doing is very important. So this endless debate about soft landing, no landing, hard landing is very typical of this particular phase of the cycle. So structurally, we're in an environment where nominal growth is really important and earnings are important, as opposed to zero rates to underpin the market, because we won't go back to zero rates in my view. Cyclically, we are in an environment where rates matter because we're in that phase where there's a whole debate about what landing we're getting. And think about the central bankers, they're like the pilots, right? So they really matter at the landing phase.
So we may get to a point where we're not constantly talking about soft landings or hard landings again?
I hope so. I'm a bit bored about it. I think hopefully by the first quarter of next year, we can start to move on.
We can only hope.
Yeah.
And almost to continue the obsession, I'm going to carry on asking about rates. So I do apologise about that.
I spent all my life thinking about them, so it's okay.
That's fine. I appreciate it. With rates looking like they will stay high, but in relative terms, I think compared to the last decade, rates are high. How are you currently viewing bonds in your portfolio? I think equities always get all the attention, but bonds are intrinsically linked to interest rates, what they will or won't do. Where's your current asset allocation thoughts around bonds?
So generally, you know, we're still favouring equities because we think that one of the challenges is that investors have been very quick to price in significant rate cuts from the Fed, and I think they're over-egging it a little bit. But having said that, you know, we are in a slowdown phase where typically bonds do offer better diversification. But I guess, so cyclically, again, a bit like what I just said now, it's typically quite a good environment for bonds when you're slowing and they're cutting rates. That does underpin the bond markets quite well. Structurally, I think we're in a different environment because I think inflation is higher for a given level of growth compared to the last decade. We're not in a deflation environment where you bought bonds at any level. We're in an environment now where we own bonds for the yield. It's the old-fashioned reason for owning bonds as a source of income, which is, by the way, when people first started thinking about multi-asset fund or balance funds 30, 40, 50 years ago, that's why you included bonds. It wasn't because of their negative correlation with equity. It was because they offered yield. Yeah. So, you know,
diversification of return.
Yes, exactly. So it's a different kind of diversification, but a very important one. Yeah. So we have to recalibrate the yields at which we will buy bonds, but they very much have a role in the portfolio.
And as if to carry on the old-fashioned theme of what markets used to react to and how you used to generate return, are we almost back to a period now where company earnings growth matters a bit? Because, again, an old-fashioned way of making return on stock markets was company earnings were strong and the share price went up. Yeah. And then we went through a decade where interest rate movements would dictate everything, whether your earnings were good or not. Could we go back to, are we in that phase again?
I think it is, because it comes back to, if you think inflation is going to be more persistent, the way you beat inflation over the medium term is by delivering superior earnings growth. And I think right now, given the expectations that baked into the market, we do need those earnings to continue to come through. So I think it is important. Absolutely.
And because the US is on a higher multiple than
Yeah,
a high
it needs to deliver
valuation.
the earnings.
So is it more important for the US to deliver earnings
Yes.
than anywhere else in the world?
Yes.
Which means it's more important for the technology
Yes,
companies.
they do have to keep delivering.
So what happens if the technology companies don't and everyone else does?
Well, then the question is, well, as long as everybody else does, I think the fact that we've got this rate cutting cycle could stimulate other parts of the market. But there will be a moment where if you look at just a simple market cap weighted index where it might struggle for a bit as the tech names come down and the rest of the market maybe holds up. But ultimately, that would be a healthy development.
Yes.
And, you know, we have ways of dealing with that. So, again, that in some sense would be quite a healthy transition if the rest of the market's catching up. If we're heading into recession, then that's a much worse situation because then you'd have the tech names under pressure and then actually the traditional sectors under pressure.
Yeah.
But that's not our central scenario. We're not expecting a recession in the States.
I appreciate that. You mentioned recession there. I didn't have any questions on
Yeah.
recession, but you said the words, so I'm latching onto that. Where are we in terms of likelihoods of recessions globally now? Surely lower than we were a year ago.
Some parts of Europe actually are sort of flirting with recession, and China clearly is still quite weak. I mean, there were big stimulus measures announced yesterday, but ultimately the Chinese economy is still struggling. But we would say in the US we see a low chance of recession. We still believe, to use the landing terminology, in a soft landing, and that's why we're still overweight equities.
Inflation. So we're going to move from interest rates straight over to inflation. Inflation, this is a question that's come in, so I'm always going to read it word for word. Inflation has become a national obsession, but from a layman's view, how is it possible to get inflation down to 2% targets if wage growth, triple locks and cash rates are all so much higher relative to that 2%? Is it possible to get to 2%?
No, I think it might be a challenge. So I think we might. So, and if you think about it, in the last decade, at one point, the Bank of England had to write a letter because it was undershooting the inflation target, right? So we've been here before where actually we haven't hit the inflation target. I think the risk now is more on the upside than the downside. But I think there will have to be some latitude there because I think we are ultimately in a more inflationary environment. And I think the reference to wages in particular is important. I think that there were a number of political trends that kind of strengthened domestic labour markets. You know, clearly Brexit here, in some senses, has reduced labour supply from the continent, but we see it also in the US with the focus on bringing jobs back home. So structural political reasons why we've ended up with stronger domestic labour markets. And in general, I think that does, again, is one of the contributory factors to why we think inflation in general will be more persistent than what we saw in the last decade. Is there a risk we don't hit 2%? Absolutely.
Is there any chance that we ever see an inflation figure that isn't followed by above the Bank of England's 2% target? Is there every single number that is ever talked about in the headlines or in the news is followed by that 2% figure?
Yeah.
Why has that 2% never changed? Is there a reason why the Bank of England have never moved that target? Because inflation moves around it, but 2% has never changed. Why is it?
Well,
2%?
it's consistent again with other central banks as well. They're all around that level, 2.5%. And it's seen as the sort of level of inflation that actually is healthy for the economy to be running, but not one which then feeds into wage price spirals and things like that. So I'd say it's a sort of, it's a consensus view across all the major central banks, around that level, 2.5%.
It's a question we get a lot of, why is it 2?
What's magic about it?
And if it started when inflation was 0 and the target was 2, and then it went up to 11 and the target's still 2, why is that never discussed as an issue? But that's a slight tangent. In terms of, one of the questions we got, which again was about corporate bonds, if inflation is persistent, and interest rates were to stay higher for longer, this is almost asking for predictions, and I admit we can't do that. Yeah, what would it mean for your corporate bond asset allocation if you felt that interest rates weren't going to go down as much as people or the market was suggesting?
As long as you're earning a decent yield, actually that's fine.
Okay.
I think the key thing when you're looking at corporate bond allocations is, the first thing is you don't want inflation to get out of control because that creates instability in the bond markets, but that's not our expectation at the moment. So that kind of helps. And then really corporate bonds are also about the health of the economy. And so, you know, generally, so yeah, we would still own corporate. Right now, inflation's moving in the right direction. And we genuinely think corporate bonds offer decent yield. But that will be the key question. While in the last decade, you could own particularly government bonds at any level because it was so diversifying and you're in a deflationary environment. I think we're in an environment where we need to be compensated for the risk to invest in corporate bonds. But they absolutely do have a role in the portfolio. And we're not talking about an environment that's necessarily problematic for corporate bonds, provided they give you the yield you need.
Sure, and you mentioned yield, and you mentioned it a few
Yield,
times.
they're there for that reason.
Yeah.
So you don't need them to be sort of rallying in terms of yield. You just need to be getting a decent income out of them.
Yeah, which we've lost sight of for,
yes,
or the world has lost sight of.
It's a boring reason for owning bonds, but actually quite a sensible one.
Boring works. It
works.
always works, and compounding works.
Yeah.
Which we talk about all the time. On a slightly different tangent where yield is concerned, so I revisited when I interviewed you in this very room in 2022, and I asked you this question, and I'm going to ask it again. We talked about the possibility then that we might be entering a period where dividends within equities might become an important source of total return once again. How has that progressed in the last 2 years? Is that becoming more of a total return?
It's been true in the UK.
Okay.
So in the UK, there's a big focus on cash being returned to shareholders in the form of dividends or share buybacks. And I think that's partly because of the structural outflows we've seen out of the UK equity market, driven by the pension funds de-risking. So certainly the UK has become a very dividend-oriented market. Less so potentially in other markets. I mean, again, the tech sector doesn't really pay dividends, right? So I think what surprised me was just how much the tech sector continued to perform, because I thought if rates were going up, and I had that view in 2022, which is right, I thought that would be a problem for the valuations of the tech market, tech stocks. But actually they kept going because I think they were so cash generative that they're actually earning a decent rate on their cash.
Yes. Yeah.
But I didn't see that one coming.
Yeah. And in terms of, you mentioned the UK having almost a culture of paying
dividends.
a dividend. Does that come from shareholders, or does that come from the companies themselves trying to keep their shareholders? So where does the demand for the... So I guess what I'm saying is, from my point of view, I'm quite surprised post-pandemic that they came back so quickly, and now you're seeing 7, 8, 9% dividends again. Is that coming from companies, or is that coming from the shareholders?
It's a function, I think, of the sectoral composition of the market, where we have quite a few mature industries represented, particularly in the FTSE 100. And if you are in a mature industry, paying dividends is one way of rewarding your shareholders.
Okay. So do overseas shareholders demand from...
shareholders asking for the dividends, I'd say.
That's pretty common?
Yes.
Okay.
Because, again, some of the growth prospects might be quite muted for some of the traditional sectors of the FTSE 100.
So it's about the maturity of the businesses.
It's the maturity of the sectoral composition. If you're in a tech-heavy index, there's less demand for dividends, because actually those are very fast-growing companies. And as a shareholder in those stocks, you want them to keep the money invested in their business. But the UK market, as I said, is more old economy.
Yeah, that's good. That's a good distinction. I've never heard it explained like that, but that makes complete sense. I've managed to go 23 minutes without mentioning the US election.
Okay.
So let's go there. There were numerous questions on the US election. So I've tried to just summarise it. US election, what does it mean for investors as we sit here in mid-September?
So I think the first thing to say about politics is that people tend to get focused on the election dates. And I think in the short term, politics doesn't matter, but it matters a lot over the long term. We've talked a bit about some of the shifts we've seen in the investment regime. For example, the move to bringing jobs back home in its various guises around the world has tightened domestic labour markets, which does impact the discount rate. So over the medium term, over a period of years, these regime changes do really have a big impact. Now, going into the US election, first of all, let's focus on what both sides agree on. They both agree on protectionism. It's just a question of how much. Again, that's a slightly stagflationary tendency in markets. And that's a shift that occurred a few years ago in US politics and is very much a feature no matter who wins. Trump might go more extreme. The other thing they agree on is fiscal policy. So I was talking about, here in this country after the financial crisis, we were dealing with fiscal austerity here. Now in a very different environment where generally seeing much more interventionist fiscal policy. I think partly a function of the COVID era where we got used to a level of government intervention that would have been unthinkable before. And so with fiscal policy, again, both sides really, no one's talking about fiscal rectitude in the United States. So expect more fiscal spending. So in that sense, it doesn't matter from that perspective. I think the things we need to watch out for, contested election could cause some short-term volatility. I would hope that would get resolved quite quickly. And a Republican sweep would result in a more extreme version of all the policies that I've been discussing, which in some senses could cause some concern, particularly for the US bond market.
And when you're saying about a US sweep, you mean president?
Both the president and Congress going Republican,
Yeah, so that's important, isn't it?
Yes.
Because there's more than one election going on.
Yes, it's not just the president, it's also Congress and split House. So I think those are some things to think about. So I wouldn't let it stop you from getting your money invested. It might cause a bit of volatility in the short term. Big picture, the US is going to remain a protectionist force, and I think fiscal spending will continue. Those are two things that I focus on the most. And then they have big differences on social policy, but that's not something that drives markets. Right?
Which makes absolute sense. When we're talking to investors all the time, and predominantly most of our investors will have long-term investment strategies. And the beauty of the US election is you get this one out of the way and you can worry about the one in 4 years' time as well. It's like clockwork. So how long you're investing for, how many of these are you going to go through? I think sometimes taking a step back and saying, this is the latest one and then there's another one. And I think we're trying to invest for the long term on behalf of clients here.
Ultimately, you want to understand how the political spectrum is shifting over the medium term. I think Thatcher famously said her biggest achievement was New Labour, right? So in the 90s, this idea of sort of fiscal rectitude and was kind of became a consensus. The political spectrum, in some sense, moved a bit in that direction. And now, in a different environment, where generally all around the world, governments are spending more.
Yeah,
that's the thing to focus on.
Yeah, but the media won't.
Yeah, the media won't.
Absolutely not. Somebody's asked a question here, which I think is quite an interesting one to ask you. How much time do you spend assessing global conflicts? I think I'm asking this partly because geopolitics was the thing that was brought up as the most common concern. Obviously, there's so many global conflicts going on. How much time are you having to spend assessing these and the potential impacts of them economically?
So again, this is very much from the lens of me looking at it as an investor. Absolutely. So leaving aside the human tragedy that we read about in the papers every day. So I don't want to sound callous, but when I'm thinking about it in the context of the portfolios, the key question has to be, how big an impact will this conflict have on our global GDP projections? And how big an impact will this conflict have on our inflation and therefore rate projections? So Ukraine was important because we were already in an inflation environment and there was a very clear transmission mechanism from the Ukraine to the commodity markets, which then fed inflation around the world. And that's why that caused major problems for us on the market front and a number of challenges. But that's what we're always looking at is, sometimes we might say conflict in GDP terms, it doesn't really matter. And if there's no obvious transmission mechanism, typically via commodity prices, then we don't worry about it so much. Again, so that's sort of conflicts, right? Then you have the bigger question about, are we in a world that's ultimately more divided? Yes, we are. We are in a more geopolitically tense environment. I think that continues again, no matter who is in the White House. And, in that environment, I think diversification is your main protection against that. Yes. And you do need to think about what that means to, which countries are the winners from this, which countries are the losers, think through the geographical allocations. That's the kind of thing we think about in our multi-asset portfolios. Yeah. And I've just summarised a very complex topic.
And you're absolutely right. I feel sometimes we're asked this question, and the humanitarian side of it is so prevalent that it's really difficult to cut through that. But ultimately, we're being asked this question because we're being asked about markets. So yes. I completely get that. What I'm almost emphasising there as well is the amount of noise that there is about everything, not just the conflicts, but about all news, everything, speculation. How does the average person even cut through that? Yeah,
which is why you have to keep coming back to what does it do to corporate earnings and what does it do to the discount rate? So I obviously spend my whole life reading papers from across the whole political spectrum, and that's always what I'm thinking about.
But how do you cut through it then?
I cut through it by thinking through, is it going to affect my GDP?
You must have seen more noise than anyone.
Yes, absolutely. And I think the key thing is, even a geopolitically tense environment can be a good environment for investment. We saw that with the Cold War.
Sure.
Now, with hindsight, we can say the Cold War was a stable system. Yeah. With hindsight, we could say that. Yeah. It didn't feel like that, I'm sure.
Hindsight asset management never got anything wrong.
Well, I'm sure people were pretty worried during the Cuban Missile Crisis, during the Korean War. I mean, there were so many skirmishes, right? Well, skirmishes, hot wars.
Yeah, absolutely.
So with hindsight now, people say that was a stable system, but it didn't feel like it at the time.
No. Yeah, hindsight's 2020. And following on from that, obviously there is so much noise. We will be told this matters, usually one thing at a time, but ultimately the media will panic about one thing at a time. In terms of the rest of 24 and into 2025, when investors are looking at their portfolios, what would you say are the issues and the risks that you're trying to position for at the moment? or are you going to say everything again?
No. The key things I would be focusing on is, do we actually get recession in the US in 2025?
Okay.
So that's not our prediction, but it's a risk that we're having to model right now.
Okay.
So that's one to think about, because that could then lead to a challenge for corporate earnings in the United States and also affect the rest of the world. The other outcome could be that we actually have a fairly stable US, but maybe weakness elsewhere in the world, which would be more like the 2018 scenario. So that's something to think about as well, is how do you position for that?
Okay.
So those are things that I'm thinking about for 2025. In terms of the sort of risk scenarios, I think the key thing we have to watch beyond 2025 and going into 2026 is the level of fiscal spending and the potential for inflation to reaccelerate as we go into 2026. Because right now, in the benign phase of inflation is moving in the right direction. But what if we start to see a reacceleration going into 2026? What does that do to the discount rate? And also in the context of fiscal spending, at what point do you get the bond market vigilantes, as we call them, sort of stepping in and saying, hang on a minute, what are you doing? And that would result in, not getting too technical, but could cause some kind of unhinging of the bond market.
Do you have inflation models, and how far into the future can you go? Because these things...
We typically go 2 years out.
2 years, okay.
And so those are the kind of things we're thinking about.
Yeah, because it's not long since the world was worrying about deflation.
Yes.
And now we've almost gone through an entire inflationary cycle in that time.
Yes. Yeah. I don't think we're going back to deflation.
Okay.
That's one thing I don't worry about at the moment.
Okay,
I'm more
brilliant.
worried about recession, or, as I said, if we get a soft landing, that's great for 2025. But then the next question will be, well, okay, but where's inflation going to get to in 2026, right? So
that's the nature
two
of these
sides
things,
of the same coin, but that's what we're thinking about.
Yeah. On a slightly more positive note, one of these questions that came in advance was, what themes, industries, sectors do you consider to be the best tonics for seemingly low growth in the 2020s? Is there any positives or opportunity? What are the biggest opportunities that you think are around at the moment for investors?
Well, I think it's interesting because things are there's lots of cross currents, even when you think about value versus growth, for example, within equities. But I think that the number of interesting things going on. I said, first of all, the geopolitical environment, the losers out of that. I mean, China is suffering partly because of that, but there are other economies that are doing very well off the back of the sort of shift in geopolitical balance. The global south in general is doing very well. It's not a label we even talked about 5 years ago. But a number of countries are in a much stronger position as a result of what's going on geopolitically. So I think that's one to watch out for. I think ultimately we're still in an era of profound technological innovation and disruption, which our stock pickers see as a source of opportunity. That's something that we continue to think about. And then, again, the last few years, the more value-driven parts of the market still haven't done that well, and I think there's opportunities there as well. So it's interesting, when I look at our global equity strategies at the moment at Schroders, they're all doing very well. So people often say it's all about tech and AI, but our stock pickers are not particularly focused on, I mean, they have exposures, but they're not, it's not like we're mega bulls on tech or anything.
Yeah.
They're finding a lot of interesting stories under the surface of the market.
Yeah.
And
the world isn't just about 7 companies.
It's not just about 7 companies.
Or 1.
Exactly. And as active managers, we find it very interesting that it's a source of opportunity for us. Small and mid caps incredibly cheap.
Yeah.
Now you need to have someone picking them for you, because there's plenty that could be value traps, but a lot of opportunities out there. That, I guess what I'm trying to say is equity valuations are not expensive. Some elements of the US are looking a bit frothy, but not bubble territory. And outside of that specific area, actually valuations look fair.
Good. Continuing the positive, I think this is asked from a positive slant from the person who submitted it. We went into 2024 with so many elections taking place. Does that mean 2025 might bring some stability?
Well, funnily enough, I mean, I did say this at the beginning of the year in one of my sort of publications. I said, look, I know there's all these elections going on, but actually the only one that really matters is the US.
Okay.
And actually, the markets end up doing very well, which comes back to what we were saying earlier about geopolitical risk. Is like you can sit around reading the papers getting stressed out about things, but if the earnings are coming through and the discount rate's under control, markets will typically rise. So actually 2024 so far has been a great year for equity investors. So the absence of those elections in 2025, I'm not sure if that necessarily, do you know what I mean? I think the challenge is that we have potentially recession risk and inflation risk going into 2026. So a couple of clouds on the horizon next year and the following year that we need to get through.
We'll focus on something else, absolutely. We're getting to the last few questions now, so this might feel a bit zigzag because these are all...
I like zigzag.
These are all client-submitted questions, so I do want to get to them. This particular one is about ESG. What's your view on the future direction of responsible investing, given the current shifts in labelling, which I think is a regulatory thing rather than anything else, and previous popularity of ESG? What's your current view where that's concerned?
Well, our view is, throughout this whole phase of ESG investing, our view has been, well, first, we always did our own analysis because we want to understand exactly how people were assessing companies. So we've always done our own work on sustainability and assessing the impact of companies on society, et cetera, et cetera. We've always thought it was important to understand those risks, particularly climate, is something we need to take into account. Ultimately, we are in a decarbonising environment. That's a major trend we need to take into account. So all of these things we have embedded into our investment process. A few years ago, sometimes people said we were too conservative because we weren't rushing to launch a whole range of Article 9 funds, as the sort of European taxonomy would describe them. We didn't go down, we weren't trendy enough back then, right? But we always said, we didn't go for exclusions, for example. We always said, look, underpriced transition is really important. Working with companies is really important. And so we've seen a bit boring for saying that a few years ago. But I think now we've seen the pendulum swing in the other direction, particularly in the United States, where people say, the extreme version is there is no climate change problem and this is all nonsense. We don't subscribe to that view. We do think climate change is happening. But the point is, I think we always take a long-term view on investment. If you're thinking long-term, then you do need to take into account some of the risks that are coming from climate and other and shifts in government policy and things like that.
But
by ploughing our own furrow, I think we've managed to get through the volatility and sentiment. We focus on making the right investments. That's all we can do.
Sustainable.
And we don't try and be trendy.
Sustainable companies rather than... I think one fund manager said to me, why would I invest in an unsustainable company?
Yes, exactly. We're looking for strong earnings we want business models that are going to survive over the long term.
Absolutely. The last two are very similar, but I think there's a slightly different slant on each one. So I'm going to ask it separately. What do you think is the best bit of advice that you could give the average investor right now? I'm putting you on the spot there, but...
Well, you know what? I'm a very boring person at parties because sometimes happily, a lot of people don't realise what I do for a living, but when they do work it out, sometimes they ask me for tips. And I always say, something we said earlier is that, actually the route to good returns over the long term is the compounding of interest, is staying the course and being a patient investor. I've always said I'm like a tortoise when it comes to investment, I'm not a hare. So that's really what I believe in, which is why people don't invite me to, or certainly people don't ask me for investment advice at parties.
What's the general reaction at parties to that?
Their eyes glaze over and then walk off. But it is really important. So that would be my advice to anybody. Often I get people who see tech stocks do really well, say, shall I go and buy some now? I'm like...
I get that a lot as well.
You're like, no, just be diversified, a long-term investor. And I think the other thing I would say is, people often say this feels like a really difficult time to invest. I'm like, it's never felt easy. I've done it for 27 years, and there's not a day I walked in saying, today's going to be easy. It never feels easy. Taking risk never feels like a good time.
But in hindsight...
So that's why make your long-term plans and invest consistently over time.
There will always be a reason to invest, but history will make you win.
Yes, but do it in a diversified way, do it proper advice. That's how you do it,
Absolutely.
not chasing whatever's hot in the paper that day or anything like that. Crypto, generally, I'd say please don't.
We're not going to go down the crypto route. I'm absolutely not going to do that. Last question, slightly similar, but I guess more about the topical news that we all hear. If you were sat in front of an investor who was worried about politics or even August's recent fall, and which we haven't covered, but how would you approach that? If you were being just so concerned, how would you approach that with an investor?
So again, when it comes to politics, we can focus on short-term election results, but it's really understanding the regime we're in. And we talked a bit about how the regime, the big picture thing you need to understand about politics right now is we've gone from an environment of tight fiscal policy and loose monetary policy to an environment of looser fiscal policy and ultimately tighter monetary policy. That's all you need to know on politics. I don't see that changing anytime soon. That's the environment we're in. and that's going to trend. So geopolitics, we are in a divided world. There'll be winners and losers, but ultimately trade continues.
Yeah.
And, you know, positioning portfolio for World War III, I mean, touch wood, but I mean, you can't position for tail risks like that.
No.
At that point, you'll have bigger worries in your investment portfolio, I think.
Yeah.
So that's what I'd say on politics. In terms of the volatility we saw in August, what I will say is often when that kind of volatility happens, people always talk about these sort of sinister flows. It'll be like, oh, yen carry trades, or we'll be talking about systematic selling, and as if it's something that's completely unrelated to what's going on in the market. These kinds of flows will be driven by what's happening to rates and what's happening to growth. So often people want to talk about sort of sinister flows. It's ultimately they're all responding to the same thing. And they might be moving fast at any given moment in time, but ultimately it comes down to, so that particular move in August was because people start to reevaluate their expectations for US rate policy and reevaluate the expectation for Japanese policy. So there's a big shift in the assumption on US rates versus Japanese rates, and that led to a series of unwinds.
Yeah.
But ultimately it was rates that were moving the whole thing.
Yeah.
It wasn't some kind of sinister computer doing it.
Yeah.
So I think whenever you read about that stuff, it all operates still on the same planet.
Yeah.
It doesn't operate in a vacuum.
And it's interesting, 3 working days into August, the world was ending in investors' eyes. And then by the end of the month, all of our clients all of our portfolios were up for the month.
Yes.
So it turned in weeks
Yes.
from one extreme to the other. And I think that's again where I emphasize how the noise affects behavior and emotions towards investing, etc.
I generally look through that kind of volatility. The politics you need to understand in the medium term, and that kind of volatility, you have to look through it in the short term.
Absolutely. Johanna, time has got ahead of us. I'm afraid I could talk to you all day. So I really thank you for taking the time to do this. Thank you so much for your candid answers and allowing me some diversions along the way as well. Indeed, thank you to everyone who sent their questions in ahead of the event as well. Thank you also to Alexa Martinez and her team, as well as the Schroders team here for setting this all up for us as well. To everyone, please stay safe, stay well, and we'll see you all again soon.